So we'll go ahead and get started. My name is Jordan Howell. We'll still have some more attendees filter in, I'm sure, but we have about 50 people who've signed up for our panel this morning. So Jordan and Daniel kind of doubled overnight pretty much, which is terrific. But anyway, my name is Jordan Howell. I'm a professor of sustainable business at Rowan University, which is a public university outside of Philadelphia in southern New Jersey. And thanks for joining us for our panel on how firms choose whether or not to participate in a new derivatives market. So we have that title as kind of the overarching theme for our conversation today, but we'll actually be looking pretty specifically at some technical issues that are facing markets for derivatives, and especially establishing new markets and new derivative products. So in working with Jordan Moore and Daniel Folkinshteyn, the problem that we're aiming to solve, this all came out of a research study on recyclable material that was supported generously by the state of New Jersey, Department of Environmental Protection. And essentially the problem that we were looking to solve was figuring out how can we improve the performance of markets for recyclable material. So even to a casual observer, markets for buying and selling recycled material are pretty dysfunctional in the US, and they have been for some time. And that was really kind of laid bare when there were some changes in other countries' policies about whether or not to purchase US recycled material. A lot of stuff was banned from China and other Asian countries a few years ago, and that kind of put a lot of pressure on the US market to figure out how to actually buy and sell this plastic and paper, cardboard, aluminum, glass, all the other things that many of us put at the curb each week. So, the gist of it is, and we'll hear more about the research findings from the first part of our project in a moment, most of these transactions, unlike other commodities, are made over the counter, so to speak. So between individual buyers and sellers, not through a centralized exchange. As a result, it's really hard to get a sense of prices, volume, any other kind of information about the state of the marketplace that you might find through other types of commodities exchanges that are really well established for most other industrial materials that are used around the world. So this is a problem because, people are more concerned than ever before about environmental impacts, and recycling is seen as one way for firms to reduce their environmental impact and also keep things out of going to landfill, be a better steward of our natural resources, and so on and so forth. A lot of large brands recently have made commitments to incorporating recycled content into their products and packaging. However, there's a very substantial question about whether or not these brands would actually be able to hit their own targets, given how dysfunctional markets for recycling are. So even though you want to incorporate recycled material, it may be very difficult for you to actually get your hands on the supply that you need. As we'll hear from our panelists, a centralized exchange for trading futures tied to recyclable material might alleviate some of these problems. However, major technical and practical questions face the establishment and operation of a futures market for recyclable materials. Fortunately for us, we've assembled this morning a group of experts who can help us better understand what would need to happen for a futures market for recyclables to succeed. So I want to introduce our panelists, and we're very grateful for all of you who've joined us this morning. I'm introducing you alphabetically, so that's how the order is being established here. First, we have Joe Arns, who's the Associate Director at Institutional Shareholder Services in their ESG division. We have Zach Dexter, who's the CEO of LedgerX Derivatives Exchange. We have Daniel Folkinshteyn, who's a professor of finance at Rowan University. Michael Ergang, the president of Global Risk Management Corporation. Jordan Moore, who's an assistant professor of finance at Rowan. Ian Shui, who's an assistant professor of finance here at Rowan University. So audience members, we can't hear you or see you by design, but if you have questions or comments, you can submit them to us in the chat, and then I'll sort of moderate your questions. We'll probably deal with audience questions at the end, just so we can sort of keep our panelists conversation rolling along here. So first question I have is for Dr. Moore. Jordan, this is the second phase of a larger research project that I outlined, focused on the potential for derivatives to improve the performance of markets for recycled materials. Can you tell us about some of the findings from the first part of the project and what our research group is looking to accomplish in this second stage of our work?
Thank you, Jordan, for the introduction. Thanks for moderating this session, and very happy to have our esteemed panelists with us today. So I just want to give an overview. This project started back in 2000. This is actually our second round of funding. We're grateful to the NJDEP for their support. So we were motivated to start this project by the basic idea that, recycling is inefficient in the sense that if you take all the material out there that could be recycled, 50% or even less is actually recycled. And this is a great cost economically and environmentally. So we believe that part of the problem, as Jordan alluded to, is a lack of reliable markets, and along with a lack of reliable markets, a lack of price certainty. So on one end, you have waste management firms, large and small, who are maybe not fully motivated to collect and sort certain types of recyclable products because they don't know what the marketplace will look like. And on the other side, as Jordan alluded to, you have a bunch of corporations across all sorts of industries that say that they would like to reduce their environmental impact, and I think they even mean it, but they struggle in practice to meet some of their pledges. So our idea was that we might want to introduce and develop markets for derivatives on various PCM products, especially the very popular ones like aluminum or plastic or cardboard. So our first stage was really a theoretical look at this problem. And one thing we looked at first was just even getting data on what kind of transactions were occurring in recyclable materials. But obviously these are opaque over-the-counter transactions. And so our first finding was that data is pretty unreliable. Fortunately, we were able to find a third-party vendor that captures a lot of self-reported data, so you have to take it with a little bit of a grain of salt on these transactions. And we were able to at least get pretty good data on a few of the major types of recyclable materials. From looking at this data, we found that the prices of recycled materials are quite volatile, especially when you compare them in a time series to volatility in the prices of the underlying new material. So recycled aluminum is a lot more volatile in pricing than new aluminum. Recycled glass is more volatile than new glass, and so on. The other thing we really looked at was the extent to which this volatility in the pricing of recycled materials affects the volatility of stock prices for firms that seem to face this as a big risk factor, namely waste management and other firms in the waste management industry. And fortunately, this industry is dominated by a bunch of or by a handful of large publicly traded companies. So we were able to get very good data on that. And we found pretty clear evidence that volatility in the prices of recycled materials translated to higher volatility in the stock prices of these big publicly traded companies like Waste Management Republic and so on. And those suggest some benefits to some of these corporations, both on the sell side, like those waste management firms, and on the buy side, like Pepsi and any number of manufacturers buying these products. That potentially, if you introduce the exchange traded derivatives, you'd have an avenue for reducing the volatility in the stock prices of these firms. So they would be motivated to participate for economic reasons, not just for environmental reasons and ESG pledges.
Yeah, so moving from the first part of our project to here, we're trying to understand some of the factors that would shape whether firms actually participate in this market were it to be established. And a big piece of that is trying to gauge how well potential market participants actually understand the benefits of a derivatives marketplace and centralized kind of exchange. So Jordan and Ian, if you want to tell us a little bit more about some of the benefits that participating in a futures market theoretically would bring to participants, I think that would be helpful before we get into some of the more technical issues.
Sure. Well, I'll start, and then I'll let Ian fill in what I left out. But one thing we talked about in our first round of research, one thing that we examined is a large body of academic literature that examines the question, what happens to the underlying security when you introduce derivatives markets? And I think it's an interesting question because on one hand, derivatives markets are associated with the ability to reduce risk and hedge. And on the other hand, they're sometimes demonized for allowing the ability to speculate and maybe distort markets in the underlying securities. So it's sort of an open question, but what we found was that the overwhelming body of published peer-reviewed academic research suggested that derivatives are a net good in the sense of increasing market quality for the underlying product. So what we mean by market quality is higher trading volume, lower volatility of day-to-day price movements, smaller bid-ask spreads, and improved liquidity, which could be measured by what we call price impact of, if you want to execute a certain amount of dollars worth of orders, how much are you paying essentially in slippage to interact with that market. So that finding was pretty consistent across a variety of asset classes, starting with the study by Conrad in 1989, Journal of Finance, examining what happened when options on US stocks started being traded on exchanges. And that finding is pretty consistent across a variety of asset classes, including stocks in numerous foreign markets, in the trading of new commodities, and even more recently, very recently, the listing of derivatives on Bitcoin and other types of cryptocurrencies. I know we have a few experts in that area as well. Another thing we looked at is, for example, the introduction of weather derivatives. Obviously, there's no underlying asset to that, but weather, be it temperature or rainfall, is something that's a risk factor to many firms. And it was shown, for example, the introduction of various weather derivatives improved agricultural output as farmers were comfortable that they could insure against bad weather conditions. And also, derivatives on average temperature was something that was very useful to utility firms in being able to hedge the risk of extremely hot or extremely cold weather. So regardless of whether the derivatives are on some underlying financial asset or just on some risk factor, be it weather or interest rates, for example, there does seem to be a big advantage in the listing of derivatives that allow firms to hedge, and that really dominates the potential destabilizing effect. But I'll let Ian weigh in on his knowledge in this area as well.
Hold on, Ian, I think you're on mute.
Yeah, thank you so much, Jordan. And I totally agree that, having a derivatives market can help a lot in terms of satisfying, investor needs in terms of hedging, for example, risk management using derivatives as a lot of times as insurance for protection against volatility in the spot market. And some investors could, use their arbitrage strategies to take risk-free profit by trading in both the spot market and the derivatives market, which is helpful because it helps with price discovery. When you have more markets, parallel markets, and more participants, they bring in their information, right? So they trade based on information, and this can help with faster and more smooth price discovery. And finally, there's also a group of investors who might be speculators. They try to profit by forecasting trends, future market movements, or they try to outguess the market. And so compared to, I think it's important that we have a centralized marketplace like an exchange, because in an OTC market, there is, surge costs for counterparties, and, forward contracts, for example, tend to be customized. And, in the exchange, if we have futures contracts, other derivatives, contracts can be standardized, institutionalized to cater to more investors so that we have a larger client base. And, I think it's also important to have higher transparency. So exchanges enable us to do that because, so there was one mishap that took place during the financial crisis, for example, the case of AIG. So they took on 400 billions, they sold 400 billions of CDS, credit default swaps contracts. And then, other traders, the counterparties didn't know about this high level of accumulation of risk. And so that was part of the reason that the government decided to bail out AIG, because otherwise there will be spillovers to other financial markets and the real economy. There will be repercussions in terms of, waves of defaults. And in the exchange, one of the benefits is that, there is usually a central monitor administrator who set margin requirements. So there is a hierarchy of relationships. Members of exchanges, they post margins with exchanges, and then other investors have to open margin accounts and post margin with the members of the exchanges, so that all the investors are governed by this margin system. They're monitored, so there's higher transparency, so that we wouldn't have mishaps like that. And these days, actually, there are central counterparties. They function just like exchanges. These CCPs, they're replacing many of those, OTC markets and transactions, precisely because this enables the regulator to have better control in this market and to be able to manage risk better. Thank you.
It sounds like there's a lot of potential for derivatives to make positive impacts for firms.
Absolutely.
And sort of the state of the overall marketplace. But I mean, it can't be that easy, I would imagine, just to show up and create this exchange. I'm wondering, Ian, if you and maybe also Mike, can you tell us about some of the major hurdles that face the success of new financial and derivatives products?
Mike, you want to go first, or?
Yeah, I'd be glad to go first. You know what? I identified three of them, really. And one is explaining the total benefits of using the derivatives to the participants. The second is liquidity, which I know has been talked about. And then the third is trust. And so from the total benefits, I think in recyclable derivatives, your timing actually is, I think is actually really good, because if you look at packaging and the impact of COVID on packaging costs, at first there were, over the last couple of years, there were several significant imbalances between supply and demand. In the food and beverage industry. And at the beginning of the pandemic, I was starting to get fewer questions on beef and pork and corn and more questions on packaging, because it went from being a rounding error to a major driver of volatility in the P&L of my customers. The other point I want to make is that in terms of benefits, yeah, there's definitely the financial benefits, but when you speak to potential users, what is the intangible benefits or the secondary benefits of avoiding the distraction in your business? And I've got kind of an extreme example of that, having spent 20 years of my career managing the commodity risk at McDonald's Corporation. When I joined the company, they didn't really manage commodity risk. They bought beef the same way they bought paper clips. When they would start to run low, they would go out and contract more. But imagine sitting down with a group of owner-operators and telling them that their food costs are not going to be nearly as volatile in the future as they had been in the past, because we're using derivatives to manage them. So you get a bunch of eyes start to light up. I mean, I could spend more time making sure my customers are satisfied and less time worrying about costs. So sometimes those intangible benefits aren't articulated, but they can often be have a larger impact on the business than the mathematical financial impacts of reducing the volatility and the present value of the future cash flows. Just want to throw a bone to the professors on the call. Then liquidity is also an important one, and because even the speculators, there's no question that they play a key role in the development of market, as Ian had alluded to. But a lot of as the speculators have become more organized and sophisticated, so has the compliance and the regulations and the governance around them. So most of the large speculators have compliance committees, and they say, well, there's a new derivatives market, okay, but you can't be more than X% of the open interest, for example. So there's some, so they do face some restrictions, and even in end users. And I could say this as an end user, we're often the least sophisticated player at the poker table. So in other words, we have we're speculators and market makers, and we've got some constraints too, as end users. But what I will tell you is that, and it's something that that I was mindful to do in my career, is that when there's a new contract, if you see as an end user, if you see long-term value in it, try it out. Try a cup. Try a small amount, even if it's maybe you're not getting completely fair value. But it's for the benefit of allowing it to the contract to grow and become successful, even if you just have to dip your toe in the water, because you're providing an enduring benefit by providing liquidity. Liquidity has to start somewhere. I guess that's my point.
Yeah, and I know you
Thank you,
have
Mike.
particular expertise in some research around liquidity and volatility related to new derivatives products. Anything you want to add to that?
Thank you. I fully agree with Mike on the liquidity aspect of and volatility of new derivatives markets. So yeah, exactly like what he said, I think, a new securities market tend to be thin, right, due to moderate supply and demand, and therefore may be subject to higher volatility and potential manipulation by speculators. And there's one special feature of the futures contracts, which is inherent leverage, which could be as high as up to 20 times or even 50 times in the FX market, for example. So leverage might induce profit-driven traders to place bigger bets than they otherwise would, right? In the, for example, in the spot market. So this may make prices more extreme, especially at the beginning. For example, I remember the introduction of energy derivatives market initially made some, markets actually more volatile, which would be defeating the purpose of, introducing this market, for the purpose of, risk management. So, and there is another aspect of it. So traders may decide to stop losses at the worst moments. Because prices can be unpredictable. For example, they might decide to sell near the market bottoms, or they might decide to buy back to close the short positions at price peaks. It's not because they want to do so, but because they carry high leverage, and this is very risky, might involve bankruptcy cost. And so I remember some of the introduction of new derivatives contracts, for example, Bitcoin futures that was introduced in late 2017, I believe, when I was still at BlackRock. And that was very successful because there was quite strong interest among traders to trade Bitcoin futures because it's more secure. You don't have to worry about password issues. It won't get stolen. It won't be lost. And then another example that was successful was micro VIX futures, which is 10% of the size of the standard VIX futures contracts. This was introduced in August 2020, and that has been very successful because household investors, smaller investors, retail investors, they had this strong demand for hedging purposes, for example, against the S&P 500 index. And then one final example I can think of, was micro crypto futures. So some of them are quite moderate and small in terms of contract size, market values. But there are also unsuccessful examples like options on DJX versus DIA. So we already had options and a well-functioning options market on the DIA, which is the Dow Jones ETF. And so when the exchange CME tried to introduce DJX, that is still actually quite a thin market, right? So I observed that there were some quite some market volatilities, for example, even in 2021. And then another example would be water, Californian, water index futures, H20, that was introduced in early 2021. And I just checked the data. Its trading volume was just 6 in March and 21 in February, and its current open interest is just 1. So such thin markets are vulnerable to profit-driven market manipulators who might decide to raise market volatility rather than reduce it. So I actually, I was thinking, how we can, try to make it better, more smoothly at the very beginning. And I totally agree with Mike that, it's important to inform the investors. So I would, recommend high marketing efforts to publicize the new securities and to inform potentially interested traders and investors, perhaps by, simulating some promotion process similar to a roadshow across the country, just like in the IPO process, to assess investor interest and to build the books, right, of potentially interested investors. And also, even if the contracts are physically settled, settled by physical delivery, there's still a period of cash trading window. So I was thinking maybe the contract, in designing the contract, the regulators or the exchanges could potentially make the delivery period a little longer for the futures contracts so that futures traders who only accommodate financial settlement would not have a wide window of opportunity to trade for profit, to speculate, to manipulate markets potentially. And then I was also thinking, we could probably invite and incentivize institutional investors to make the market, so that this involves informing them of the potential benefits, the fast growth, and the greater prospects, right, of this market for recycled materials. And if institutions can decide to participate in this market and make this market, become the market makers, this can not only improve their own ESG profiles, but also help make this market less volatile and more stable, right, and more liquid. And I was also thinking, when standardizing or institutionalizing, for example, futures contracts, it might help to cater to as many potential investors as possible, but just to maximize the client base, the supply and demand. For example, we could, learn from the micro, cryptocurrency futures examples to make these contracts as affordable as possible, like, maybe of moderate size market value, notional value, and make the delivery periods longer, and maybe also, study the spot market to, follow some typical delivery patterns in this industry, so that when the during the delivery period, right, it also happens to be a very active time period for the spot market. And finally, I would just want to mention, again, the importance of higher transparency in this market. For example, maybe we could try to assess the purposes of the traders of derivatives of recycled materials, such as, we can ask them, by questionnaires, are they going to hold on to their contracts for physical delivery to the very end, or do they try to close out their positions with profit? Are they just speculating for profit, right? And if they respond that, we're just trading for profit, then it might help to kind of inform them that, this market, it's monitored by the regulators, and it's really in their own best interest to not to try to manipulate the market in potentially in the suspicious illegal ways, right, to try to push the prices up or down by too much for the sake of their own profit-driven motives. Thank you. I think that's all I wanted to say. Thank you.
Yeah, that was a lot. And we'll return to some of the nuance in cash versus physical settlement, and also some of the ESG tie-ins later on. So lots to think about from Ian. First with the Mike, with the question of attracting users, what's your perspective on, steps for getting end users, whether they're just sort of natural hedgers, if they're speculators, if they're market makers and institutions, large corporations that might benefit? What's the pathway to success in attracting market participants?
There's a couple things. I really like Ian's idea about the roadshow, because there's a marketing aspect, an underappreciated marketing aspect involved in launching a contract. And sometimes, particularly the end users, there's undiscovered benefits that they unanticipated or undiscovered benefits. So, I've worked with the Chicago Mercantile Exchange over the years, and, advising them on launching contracts. And I think they have an appreciation of the marketing aspect. But I think that's a real important one, because sometimes when people participate in the process, they tend to be more engaged after the fact. So after the contract's launched, they had, even if you don't take every idea that every person you talk to recommends, the fact that they had a seat at the table, provides some buy-in. So I think it's really outlining some of the benefits, having a roadshow that outlines the benefits and addresses some of the concerns that end users might have.
Yeah, so that's a great place to start. I guess Jordan and Daniel and I can all pack our bags and go to various recycling facilities around the country. For Mike, and then also I want to bring Zach in on this question. I'm wondering how much the mode of settlement matters for building a new marketplace, cash versus physical settlement. What do you guys see as advantages and disadvantages to physical versus cash settlement for derivatives contracts, especially in a new market?
Well, I'll go first. I think the base case is that physical settlement is preferred. But as an end user, I always looked at physical settlement much like my Fifth Amendment right to remain silent. I hope I never have to use it, but I'm thankful that it's there, right? So there's probably no more sincere way to keep a futures market honest than have the right to threaten to make or take delivery of the underlying. I know Ian had spoken to some distortions. I'll use the word distortions. You could also say arbitrage opportunities that have been created. But if you're an end user and you have to do it, and you have to execute a trade while there's a distortion going on, that could be very inconvenient. So the right to be able to threaten to make or take delivery is first and foremost is a very significant line of defense in preserving the integrity of the market in which you're anticipating. Look, I'm not saying, when I worked for McDonald's in Oak Brook, Illinois, I'm not saying I want 800,000 cattle mooing for me in the lobby, but the fact that I could threaten delivery went a long way in convincing those around me of the integrity of the market. Now, in terms of cash settlement, it's a little more muddy, and it's evolved over time. Cash settlement is a very clever way to offer derivatives on products where maybe physical settlement isn't possible. And but it really, as an end user, you're really hanging your hat on how robust that cash settlement process is. Now, I'm one of the older guys on the call. There was a time when LIBOR was believed to be was believed to be unmanipulated, right? I mean, the thought of LIBOR being able to be manipulated is, I don't know, it's like finding out that Mickey Mantle corked his bat. I mean, it's not something that anyone would have participated and would have anticipated. And I think what that does, it's created maybe a little more suspicion on the cash settlement, because you're really hanging your hat on how that index you're settling against is articulated. I'm not saying it can't happen or it's an absolute problem, but I think what happened, what happened with LIBOR maybe causes some end users to look at cash settlement with a bit of a more critical eye.
Yeah, I'll add on to that I think cash settlement is most appropriate when you have super deep liquid spot markets where there are a variety of natural longs and shorts. Ideally, electronic spot markets with SOC 2 audited data reporting. That's kind of the only case where cash settlement is really easy to do. I think the regulatory standards for cash settled products continue to climb. You've got to go out and get BMR and IOSCO certifications if you want to get your product listed quickly. And it's just gonna keep getting harder to design something that's not, to use the regulatory term, readily susceptible to manipulation. Obviously, we've run a physically settled crypto derivatives market for like 8 years, and some people love it. But the downside is that we're warehousing the underlying product, and that can get hard too. If you're talking about recyclables and you want to go sell an option or something, what are you going to do? You're going to post a bale of recyclables to a warehouse? In some cases, the answer is yes. And you run up into a similar question to the index construction question, which is, well, what is a bale? What kind of material goes in there? Who's auditing that? But even with those challenges, I think if you look at the existing environmental derivatives out there today, they haven't really been successful, and a lot of them are cash settled products on indices that have all kinds of issues. Most of the environmental indices out there, you've got countries that participated in an index related to their rainforest coverage, and now well, their index methodology was a little bit different than some other countries, so now they can't sell derivatives on that. And you've got people who try to use derivatives as kind of a funding market. If you go crazy with index construction, and really derivatives are a risk transfer market. That's all they should be. They shouldn't be a funding market. I think the low rates environment drove us more towards, you know, people seeing derivatives as a funding source, and some of the infrastructure builders in this space would like sell options, you know, using collateral that they really should have been deploying towards building infrastructure. And then when the trade went against them, they, you know, some of their infrastructure building money is gone. So there are all sorts of problems with cash settlement. I do think it would be worth it to, you know, construct a network of warehouses that can sort and classify and accept recyclable materials and kind of see if that works. The cash settled products that are out there today for like virgin plastics, I mean, who cares? You know, that doesn't help anyone meet their ESG goals. That doesn't help anyone meet their recyclable content goals. So I think if you want to see a successful product in this space, it's got to be physically settled, despite the pain associated with figuring out what is the unit. I think it's worth the effort.
Yeah, and the question of what does the unit look like, an audience member posted that question as well. We'll get to that later on. In the meantime, Zach, through your company LedgerX, you have tremendous lived experience with the regulatory, you know, environment, as well as the kind of customer-facing aspects of launching a new derivative exchange. So, can you give us an overview of some of the major issues in these areas, regulatory, and then also like kind of, you know, retail customer facing, and we'll bring in Daniel on this question too a little bit later. How do you
Yeah.
attract and retain customers and then deal with all the regulatory stuff?
Well, the typical route to launching a new derivatives product is to just use one of the existing exchanges. They're very established, you know, they've been around for 100 years. They like to tell you about their 100 years of risk management experience, especially if you're me and trying to compete with them. So it's a hard space to get into. And usually what happens is people will spend 10 years launching a new product, and then CME will spend 1 week copying it. And you know, you'll have some activity, and most of them kind of don't work out, and a few go on to be successful derivatives products. But throughout the process of launching, you've got to deal with a really antiquated system in the commodity derivative space. You've got brokers who are relying on software that's decades old, that only supports 4 decimal places. And you've got to schedule the clearinghouse, the central counterparty, to like upgrade its margin model to support your new product or your new asset. You've got to schedule the brokers to integrate with that margin model modification. You've got to get the brokers to, you know, work with your product. You've got to set up all the regulatory reporting. You've got to find an exchange that is connected with that clearinghouse and those clearing members to list the product. So we thought, this is ridiculous. Let's start a vertically integrated exchange and clearinghouse. Not very easy. And I think an ideal state 5 or 10 years from now for the commodity derivatives markets would be a more competitive landscape, where people who are looking to launch new products can partner with one of many exchanges instead of one or two, because the iteration cycle on derivatives right now is like 10 years to know whether a product is really going to work. It's just really hard, and you should be able to try to go to market with something in a year or two, and you know, see if it's a hit, see if you can attract customers. In terms of attracting customers, it's just a sales job, right? I mean, roadshow is a great idea, but typically people will set up market maker programs with equity incentives or volume rebates. One of the problems with the recyclable derivatives is, well, we all want to do physical settlement, but the trading shops don't always like that, because they, you know, you have a natural mismatch of longs and shorts in most of these environmental markets. So you really need the speculators, and actually cash settlement is incredibly good for them. If you have physical settlement, it's really hard for speculators to participate. And that can be a bad thing, actually. Speculation, as long as you've got a strong market surveillance program, is what provides the other side to hedging. It's what allows the hedging to happen in markets that have, you know, unbalanced natural long and short ratios. So it's tough. I mean, I think it's worth a shot, but to attract trading institutions into a physically settled derivatives market, you've typically got to have significant equity incentives on the exchange, and you're not going to get that with an established venue. So that's That's our angle.
Yeah. Daniel, I know you have some perspective on the challenges of bringing in customers and market participants in new exchanges as well, and the role of this kind of capital efficiency and margin requirements and all of that. Wait, you're still on mute though, Daniel. There you go.
Can you hear me now?
Yeah, there you go.
Okay. So I guess I just wanted to connect this to kind of my own experience as being a customer at LedgerX, right? And just talking with some of the other participants and what they're thinking about it. So yeah, like it is kind of very much a chicken and the egg problem. You don't want to go sign up for an exchange if there is no liquidity, right? But if nobody signs up, there is no liquidity, right? So it's definitely like a difficult bootstrapping problem. And there is a significant network effect to this whole situation, where the more people you have, the easier it is to get more people. So this is certainly something that we have to think about as far as building the book and getting people to participate. So Ian's roadshow idea, as well as other marketing ideas, are probably a good start. The other thing is also like you're kind of competing on capital efficiency as well. Like if you have, like there are other places to participate. For instance, at LedgerX, the default setup is that there is no leverage whatsoever. If you want to say sell a call option on Bitcoin, then you have to post the full Bitcoin that you're selling the call option on. And that is really, I mean, that is really great from a risk management perspective, right? You don't have to worry if you buy a call option that the other guy somehow might not have it, right? Or that the exchange margin tracking system will fail to adequately keep up with the volatility and things like that, right? You don't have to worry about it. The exchange also doesn't have to worry about it, right? Because they don't have to say, oh, let's adjust our margin requirements based on the volatility, and you'll have to send out margin calls and all of that stuff. You don't have to worry about it. But on the minus side, right, if there is leverage, if I could say post only half of a Bitcoin to sell a call option on Bitcoin, then using the same amount of capital, I can trade twice as much stuff, right? And so I've definitely heard from some of the other participants how like they wish it was possible to be a little more capital efficient, so you don't have to lock up 100% of your cash or Bitcoin in order to enter into these contracts. But probably Zach will be able to speak more towards the regulatory side of things, because I'm pretty sure as soon as you even breathe the word margin or leverage, the regulators will be all over you, and you would have to provide all kinds of extra compliance information and all of that kind of stuff, just to prove to them that you have the expertise and the systems to make sure that it's not going to blow up if the underlying moves significantly and suddenly there's not enough collateral. So yeah, maybe I'll pitch it back to Zach to discuss the issues with possible margin requirements and stuff.
Yeah, I mean, when you're trying to get the regulators to approve certain levels of an initial margin for a particular product, you've got a pretty prescriptive framework that you're working within. Most people use something like an exponentially weighted moving average model. The famous one is a CME span. There's a new version of that coming out soon, but you've got to have a sophisticated methodology for proving that initial margin would have met the regulatory requirements over a certain backtesting period, and you've got to have a backstop to protect against the chance that it doesn't. One of the issues with cash settled products, we actually saw this on a commodity exchange recently, the London Metals Exchange. They almost had a cover 7 event where if they didn't cancel some trades that went a little bit wild, they would have had to bail out 7 clearing members. But clearinghouses, central counterparties after Dodd-Frank, only have enough capital to bail out 1 or 2 clearing members. So it would have caused another cascade across the financial system, which leads you to ask, do we know what we're doing with risk management, many years after Dodd-Frank? And I think the answer is no. Where did the number 1 or 2 come from in terms of how much capital clearinghouses have to bail out clearing members, and it came from the assumption that the largest one or two will be very large, bank FCMs. That may or may not be true in the future with consolidation in that industry. So the question of margin is a tough one, and it gets a lot tougher in an area like environmental derivatives where you don't have a reliable spot market, which again points you really towards physical settlement, physical delivery, because unless you've got a reliable electronic spot market with honest brokers, you're going to have a problem. But I'll just leave you with this thought. Even if you set up a perfect physically settled system and you have warehouses and you're shipping around all these goods in containers to the warehouses, you've got the problem of honesty. And we saw recently there was a massive fraud, Trafigura, I think, where traders thought they had title to nickel that actually did not exist. So in the international context, even if you set up this physically settled derivative system that you think is so great, you've really got to police the supply very carefully, or you could wind up with many of the same problems that you'd see in a highly speculative cash settled market. So all the more reason for this kind of trading to move to regulated platforms. I think the U.S. has a great framework for dealing with this kind of stuff in a highly regulated fashion, and too few people pursuing interesting new derivatives.
Yeah. There's a lot that to consider, obviously, and bringing up the issues of trust and honesty and sort of integrity in the marketplace. Another member of the audience, so to speak, for a derivatives exchange like this one would be, individual and institutional shareholders. Joe, I know that you work directly with everyone's favorite new investing acronym, ESG. In our research, we'd like to think that a futures exchange for recyclable material would help firms and brands kind of meet the environmental pledges that I mentioned at the start of our panel. Is there any hope for that? How do the firms and industries that you work with differ as far as how much their ESG policy focuses on using, recycled materials and meeting environmental pledges and what they disclose and so forth?
Yeah. Thanks for that. I mean, and on the acronym ESG, I think it's been so poisoned now that we'll have to retire that here pretty soon. Maybe focus on a new term. But with respect to policies around recycled materials and reporting on them, there really are big differences by industry. And I'd sort of break it down into two tranches of companies today that report on recycled material use. If you're reporting on recycled materials, then you're clearly trying to manage that. You may have interest in a market like a more transparent, more efficient market for recycled material use. So in some industries, recycling clearly has a big impact on mitigating externalities. This is clearly evidenced by how companies report. So companies involved in metals and processing production are typically going to already disclose details on the percentage of recycled materials used, be it scrap steel or aluminum. Also, producers of construction materials will often report on things like recycled asphalt, synthetic rubber, as well as construction waste. So again, industries with big impact are going to be fairly likely to report at this stage. And then you've also got a second tranche of industries where you're seeing a good disclosure, and those tend to be consumer-oriented industries where there's clearly some impact, but where really the reputational risk to the company is probably the big driver and motivator there. So companies selling consumer electronics, clothing and apparel are much more likely to disclose than other industries. And even where but even in those industries where we do see a lot of reporting, there's still some pretty big data gaps. And this is something that's an issue sort of across, non-financial metrics or ESG data. So on average, in the industries where we do see reporting, roughly half of companies are still reporting nothing at all. And then another 30% or so will make some general claims of using recycled content in the products. They won't actually disclose figures. And then so you kind of wonder, well, just how much are they actually using at this stage? But then the next biggest category, roughly 10% or so, are those companies that are already demonstrating what we would consider best practice. That's measured either by a clearly increasing trend in the use of recycled material, or maybe achievement of recycled material content above a certain percentage. So in the metal space, that can be pretty high already, more than half in some cases. In other areas, perhaps a bit less. And there's another example, in clothing and apparel space, about 80% of companies don't report any figure whatsoever, but 10%, those sort of on the best practice level, are already using more than 30% recycled content in terms of petroleum-based fibers. So this gap again between sort of those who are reporting the highest uses and everyone else suggests that at least in some of these industries, there's great potential for much bigger quantities of recycled material use.
Joe, in your work, do things like pledges to improve environmental impact by using more recycled materials, does that actually affect ESG ratings, or does a failure to meet a public pledge affect ratings in any way, or not really?
Yeah, it depends. So maybe I'll just give a little bit of background on how the rating works. So typically what we're trying to measure is management's sort of intention to mitigate negative externalities, or in some cases, promote positive externalities. So, and it really goes much further beyond commitments or pledges. We're really looking to see, are there management structures in place? Is there accountability? Do you have are there actual actions that are being undertaken today? And then is there evidence of any progress on that? That's really what we tend to put a lot of weight in the rating on. Are there actions? Are those actions translating into improvement? That sort of speaks to the intentionality of the company and actually mitigating the risk. So again, to take the example of clothing and apparel, we'll put a lot of weight on the company's strategy to extend the useful life of their products, including evidence of programs in place. And then we've got a separate indicator that we look at the percentage of petroleum-based recycled fibers in use. So in most cases, if a company doesn't meet a specific pledge, it's not going to really negatively impact the score, as long as there's a trend that's stable or improving. Really, again, what we're trying to measure is the company's attitude through various measures. And frankly, this is kind of a function of where most companies are in terms of the spectrum of sustainability management. Climate targets, I think, are a perfect example. Targets tend to be several years or decades out, and we can try and estimate whether they're on track, but it's pretty difficult. So we often sort of fall back to assessing near-term trends and use various benchmarks.
Yeah, it's an imperfect science, it sounds like, very much in contrast to maybe some other ways of measuring. So we have a couple audience questions. Two of them are sort of like technical questions about recycling that I'm happy to answer. And then one I think is a great one for our entire panel to take a crack at, from our very own Rick Johnson, professor here at Rowan. Thank you, Rick, for your question. So the first two, the first question, which commodity looks like the best candidate to start with? Aluminum and glass are suggested. I've spent 10 years studying the waste and recycling industry. My book is coming out in about a month. Feel free to buy it from Rutgers University Press. It's called Garbage in the Garden State. But basically, there's not much hope for a futures market for pulp and paper. So paper products and cardboard is probably unlikely to perform well, just because the OTC market is so well developed that people who participate really would not have much reason to participate in a centralized exchange for pulp and paper. There's another firm that's a European firm that's launched a futures contract like what we're talking about for recycled corrugated cardboard in Europe, and I believe it exists, it trades now, but I think they're having some trouble finding a lot of liquidity, and it's very thin. So the likeliest candidates are probably aluminum, recycled aluminum, because it's easy to manage from a recycler's perspective, and it's in high demand. So there's an end market for it. And then probably different types of plastic. What to do with plastic you've recovered has been a question that's haunted plastic recycling since plastic recycling started in the late 1970s. No one knows what to do with recycled plastic, unless the prices are so good that it's worth it to process it and kind of chop it into these pellets that can be used for making new plastic product. Now, recently, what's changed, as we said at the beginning, is that a lot of brands are committing to increasing, recycled content for plastic packaging. So it's possible that regardless of what the price is, there's just the value in being able to secure a supply at a price that far enough in advance to actually meet some of those pledges. So probably the most realistic candidates are certain grades of plastic and recycled aluminum. Another question was, what this question of defining what is the unit that would be in a contract. Well, there is something called the Institute for Scrap Recycling Industries, which is an international trade association for firms involved in recovering and processing materials for recycling purposes. They publish guidelines on what should constitute a unit of number one plastic or recycled aluminum or certain types of paper that specify things like quantity, quality. There's different grades that are established. And a lot of recyclers around the world do follow those guidelines. However, at the moment, not all recyclers do. So in some corners of the industry, if you're if you're very prominent in one particular type of material and your specifications for what a unit of that material is differ from ISRI, well, you don't really care because you have a pretty well-established book of business and they know what they're buying and what that quantity looks like. So there are some guidelines that exist out there. It's trying to get everyone to agree that the published guidelines, the international ones, make sense for everyone. That may be something of a challenge. So the question I think that maybe all of us on the panel could take a swing at comes to us from Rick. So what is the likelihood of a recyclables commodities market materializing in the next 5 years? I as a person working on this from a research perspective, I hope it materializes because it would be cool and I think have some positive environmental impacts. However, my hope that it would materialize just for those reasons is probably not strong enough. For our experts in the world of commodities, derivatives, and ESG, what do you gauge as the likelihood of something like this coming into being? We can start with Mike maybe, and then Zach, Ian, and Joe.
Yeah, you know what? I actually like. I'm optimistic about the success of this of an equity of a derivative in recyclables. Probably the largest reason is that there has been a heightened focus on volatility management over the last couple of years. I mean, it's been significant. So you have a scenario where you had a tremendous number of imbalances created by COVID. And then just when Omicron is finally dissipating, the second largest energy producing country invades one of the largest grain exporting countries. So you now have a new wave of volatility. And a lot of companies have been looking at the volatility in general and saying, you know what, we can't ride the peaks and valleys anymore. We have to do something about it. And I think that trend is, I think that trend will benefit the need for price certainty in all aspects, including recyclable materials.
Well, I mean, I think you already have some live recyclable contracts on CME, arguably with steel and some other stuff. But in terms of new markets, let's just say there will be 100% chance. Now, the success of the market, I think, is another matter. But definitely, at least someone will give it a shot, and I think that'll be a physically settled product.
So thank you. And I was thinking that maybe more environmental related regulations, higher regulatory requirements on environmental friendly compliance might actually drive up the demand for this market. So and there are some new markets like electric vehicle markets, right? So there will be presumably a lot of batteries of EVs to be recycled, and so so that I would imagine that this demand and the potential size of this market could go up over time, and which makes it more likely that we're going to see a market like this within the next 5 to 10 years, and also like for derivatives markets, like futures contracts, they make it easier to short the commodities, to short the market, which helps us price discovery and meet certain traders and investors' demands and so forth. Thank you.
Joe, what's your take?
Yeah, I think maybe just building on Ian's point, so by 2025, essentially any company of any size in Europe is going to have to report on a whole host of environmental impact measures. I think that's clearly going to help drive demand. And frankly, it's also going to apply to any multinational that does a lot of business in Europe as well. So I think from the corporate side, the regulatory requirements are only going to increase over the coming years, and I think that would certainly increase their demand for something like this.
All right. Well, that's the end of our time for our panel. I really want to thank our panelists once again for joining us and sharing your expertise. It was really beneficial for us as researchers, hopefully for the audience as well. If I can comment, there was a question about pointing out that an effort like this has been attempted in twice in the past 3 decades. Yes, this is true. Yes, we are aware of it. The first one was an early 90s attempt by the Chicago Board of Trade to mostly focus on trading paper contracts, recycled paper, and that collapsed for a number of reasons, some of them technological. The technology situation for trading is very different nowadays than it was in the early 90s, so we think that's maybe a factor. The second effort was led by Enron, which was about to sort of ramp up very, very shortly before that company imploded. So we're hoping that, those are not harbingers of our efforts here, but also that there's enough change more broadly in society that there'd be some more kind of widespread support for an initiative like this to help achieve environmental goals. So no, we don't know of any studies that actually detail those efforts. If you do, please send them our way. We've spoken to some of the people that tried to launch them in the past, and they've given us various reasons that I just outlined as to why they failed. But yeah, so anyway, thanks once again to our panelists. It was great seeing you all, and we'll be posting a recording of our panel discussion this morning to our project website. If you'd like to just relive it all again, you can certainly go check it out there, or scope out anything that our panelists said in more detail. We'll have that information posted shortly. But for now, thanks so much, and we hope to be in contact with everyone soon.